So when someone's looking at a captive, one of the reasons they're considering it and one of the, the things they're looking for is to drive down their premiums, drive down their cost of risk. So a captive is usually a more efficient structure. You certainly have a lot more flexibility in how you structure your risk and, where you take retentions and deductibles. And so generally speaking, you're going to get lower premiums. And, that's one of the driving reasons people come to captives, right? You can manage your cash flow, reduce your initial paid out premiums. And then, the counter side to that is to retain underwriting income, right? So if you have a great year and you have very few claims, very few losses, all of that underwriting profit stays in the captive and that becomes your underwriting profit. And I actually have a great example of that. Through COVID, we actually had a client that issued premium holiday for two of its ongoing underwriting years. So they actually had a long established captive that had built up significant equity. And through COVID, with all of the risks associated with it and the lower income for the hospital, we were able to issue a premium holiday 2 years in a row, which totaled about $25 million. So, the benefit of all that underwriting income over the years and the significant equity they built up allowed the hospital to, reduce their premiums by $25 million over the course of 2 years, which really helped them in their cash flow needs through COVID.
I think as well, when we're looking at some of the benefits and kind of a tie-in to retaining that underwriting profit is also the benefit of how med mal is very long tail. So, particularly in the first 1, 2, 3 years of any med mal program, there's going to be limited paid claims. You may have reserves. You may be working through the process of knowing about large claims, but the horizon certainly is at least 7 years, if not 10, for your first underwriting year to really be closed off with confidence. So there's a really big delta between, when you're paying your premiums and when those claims are being paid out. So all commercial insurance carriers, for longer tail risks, where they mostly make their profit is on the investment side rather than specifically the underwriting side. Someone like property, they need to make underwriting profit because it's very short tail. For life insurance, which is very long tail, it's all investment. And MedMal is somewhere in the middle. So we were working with a client on a feasibility, and they had $30 million per year in premiums. And just looking at the analysis of if they had taken all of that risk, that 30 million per year for the last 10 years, where if they had put it into their own captive insurance company at a certain number of expenses, certainly for fronting carrier and admin, and looking at the claims dispersion over how the claims are being paid out and when. If you look at the investment income over a horizon, it started building significantly. It started off at a certain percentage, even in conservative investments, it really grew larger and larger and larger. And what that allows you to do when you are operating your own healthcare captive is not only are you benefiting from that underwriting profit, if you have great claims management, if you have great processes and you try your best to avoid claims where possible, certainly claims are unavoidable, but if you have belief in the protocols and risk management, you should profit in your underwriting. And then on top of that, you've got this investment income on top. So even if claims go badly within a captive structure, because that's a question we get a lot, what happened when things go wrong? Where is my exposure? I'm worried about that. And you can strategically place reinsurance, whether it's on the specific or within the aggregate, protect the group for that. And on top of that, the investment income gives a really good delta. Every year, you're gaining investment income on claims not being paid out yet. And that allows you, even if in a bad underwriting profit year, let's say you broke even or you made $1 million loss, you still may be profitable overall because of that investment income. On top of that as well, we touched on the benefits of, having more carrier partners. And this is a really big one as well, because, looking at the market, it's shrinking. There's limited choices. The doctor's company is purchasing ProAssurance. So probably two of the largest players within the med mal space are consolidating to one. So it's making it even harder and harder to get options. And for our clients to have the ability to have options within the marketplace, being able to go to the reinsurance market, even if it doesn't make sense price-wise today, that they should stay in the commercial market. If they have a captive open, if they're doing their self-insured retentions, next year they can look at it again. Next year they can look at it again. And at some point, it's going to make a lot of sense for them to make that move over. So having options is a major benefit for any hospital group.
So one of the first things that we're going to look at is sort of your loss ratio. Do you have a good loss history, a good loss ratio? Does it make sense to, start your own captive and take your own risk? Because at the end of the day, how much you pay out in losses relative to your premium is predominantly the driver of, success in the captive space. You would also need best in class risk management, a commitment to safety, trying to keep claims down, incidents down, anything that keeps that risk management showing up on the loss ratio, right? So, keeping our claim history low, keeping claims down is going to be a real driver of, success in the captive space and whether a captive makes sense for you. Then there's also size. So premiums should really be at least 1.5 million. You have to be large enough to take your own risk and really, drive the size of the captive so that there's the costs associated with running captive, are mitigated. We're looking at if you have high deductibles already, if the 150, 250K range, you're already in a great spot. Captive could certainly make sense with those deductibles already in place.
No, that's a great point. Oftentimes the market, when they start forcing these retentions on you, it's really an indicator that you're of a bigger size, that you can look at the captive, space, and you know, like that as part of any great risk management, system. You want to make sure that you're financing the risk. And I think for a lot of CFOs, sometimes you could take high retentions, or it's recommended to keep your premiums low, but there may be a fundamental understanding of, or misunderstanding, I should say, of, where's my risk lie? How much of, I'm getting a premium credit for this, but how many claims can come through here? What are we on the hook for? And as we mentioned earlier, there's a long tail between claims reported and claims paid. And they all could potentially come at the wrong time for the business within your liquidity needs. So, whether you're in a self insured retention reimbursement structure or a fully fronted captive, I mean, it's so important to make sure that the business has the appropriate cash management and cash flow to pay these claims. And that's one of the benefits of the captive, is that you're interweaving your risk management structures. You have full transparency on your claims, full transparency on what the actuarial projections are. So into the future, whether you're making money, whether you're losing money. And in reality is that when claims come through, and a lot of people can have poor claims performance, but if you have a captive, you've financed for that already. So there isn't this liquidity squeeze, there isn't this real worry over the program because it's already set up in the captive. Um, I believe, and I would say this to any CFO, that it's quite dangerous to take large retentions and not have a captive in place to really guide you to how much risk and how much financing is within that. I think it's a key component of any risk management framework.
Yeah, I would also add in the healthcare space, captives are very common. You're certainly hard pressed to go out there and find hospital systems across the board where they won't have a captive in place. So these are very common structures. Depending on what level of risk you feel comfortable taking your own captive varies, but having a captive in place for a healthcare system is very common.
As part of any captive journey, we're a full service manager. So that's from initial conversations, feasibility consulting, formation of the captive, and as well as the day-to-day management of that captive insurance structure. So, a lot of our conversations are day one, where we have brokers and clients that are looking for a solution. They have certain pain points, and we're able to guide them a lot, within that. When we look at their policies and overall structure, we can tell very quickly to say, yes, that could make sense to do a bit of analysis and to look if a captive makes sense, or sometimes it's too small. Sometimes there may be particular reasons why those risks mightn't work. So what we like to do is, to give value upfront, to make sure that people's time is well spent. When we go through the process, often, one of the first steps is a feasibility study engagement. So really, we're looking at the total cost of risk. We're looking at all of the insurance lines. May not just be the med mal, even though that's often where retentions tend to focus. But if there are other specific coverage lines, also we would consider that. And we take it through the full structure. So we look at the ownership of the captive within the hospital group. We look at the insurance structure, what retentions make sense, how premiums may look like, or what claims projections might look like. And we work with independent third-party actuaries as well to back up all of these figures and analysis. Domicile selection is a key one. Whether it's a U.S. domesticated captive or whether it's an offshore Cayman Islands healthcare captive, there's a lot of variety and nuances between the domiciles that can be important to each hospital group. So we do a very full analysis to see where they may fit in best. We look at, talking and educating is a big part of a role as well, because, certainly we're dealing with healthcare professionals. They're exceptional in their field and they have great experience within that. But the insurance part is our role, really. So we need to educate through the process and to show why it makes sense and how is it being operated, and we try to make it as turnkey as possible so that your healthcare board can focus on the important matters. There's always a certain level of work when you have a licensed regulated entity, but risk management advisors try to make it as turnkey as possible. um, After a feasibility study and we look at all of the numbers, we're working with your broker, and from a financial point of view, from an operational point of view, if it makes sense for the hospital group or healthcare group, whomever it may be, to form a captive, then we start the formation process. That's really where you're getting the legal formation of the captive insurance company and the domicile. Risk management advisors were preparing a insurance license application. So that's a detailed plan that outlines the operations of the captive, who the directors and officers are, who are all the service providers. So whether that's tax or accounting or legal, all of that wrapped in. So very important part of an insurance license. We submit that to a domicile regulator, and typically between 4 weeks to 8 weeks, depending on what domicile you choose, you'll get your insurance license. Coverage is bound, policies are issued, and then your captive is operating day to day. So as a that's how we do it on a step-by-step basis. But really, risk management advisor's role is to be, clear, concise, and a trusted advisor to the brokers as well as clients as they go on this journey.